Working capital. Working capital is the capital used to fund the day-to-day operations of a business. It's the difference between a company's current assets, like cash, accounts receivable, and inventory, and its current liabilities, like accounts payable and short-term debt. A positive working capital means a company has enough liquid assets to cover its short-term obligations and run its operations smoothly. A negative working capital indicates a company may be at risk of not being able to meet its short-term financial obligations. Key characteristics: short-term, used for expenses within a typical operating cycle, usually 1 year. Highly liquid, consists of assets that can be easily and quickly converted into cash. Operational, essential for ensuring a business's daily functions, such as paying salaries, purchasing raw materials, and covering rent. Fixed capital. Fixed capital refers to the long-term investments a business makes in durable assets that aren't consumed in the production process but are used to generate revenue over many years. These assets are often essential for the business to operate and expand. Key characteristics: long-term, used over a long period, typically more than 1 year. Low liquidity. Fixed assets are not easily or quickly converted into cash. Strategic. Supports a company's long-term growth and productive capacity. Examples: land, buildings, machinery, equipment, and vehicles. Assets. An asset is anything of value a business or individual owns or controls with the expectation that it will provide a future economic benefit. In business, assets are what a company uses to produce goods and services, and they are listed on a company's balance sheet to show its financial health. Assets are generally categorized by their liquidity. Current assets. Assets that are expected to be converted into cash, sold, or used up within 1 year. Examples include cash, inventory, and accounts receivable, money owed to the company by its customers. Non-current, fixed assets. Long-term assets that are not expected to be converted to cash within 1 year. Examples include property, plant, and equipment, PP&E. Intangible assets. Non-physical assets that have value. Examples include patents, trademarks, copyrights, and goodwill, the value of a company's brand reputation. Wealth. Wealth is the total value of all assets owned by a person, family, or nation, minus all liabilities, debts. It represents the accumulated stock of valuable resources at a specific point in time. In economics, wealth is a stock variable, meaning it's measured at a single point, while income is a flow variable, measured over a period of time. Key characteristics. Net worth. The most common measure of wealth is net worth, which is calculated as assets, liabilities equals wealth. Diverse components. Wealth can consist of both tangible assets, like real estate, cars, and gold, and financial assets, like stocks, bonds, and cash. Relation to income. While income is a flow that contributes to wealth, a high income does not automatically mean a person is wealthy if they also have significant debt. Wealth is the long-term accumulation. In simple terms, working capital is the fuel for daily business operations. Fixed capital is the long-term machinery and infrastructure of the business. Assets are everything of value a company owns, and wealth is the total net value of everything a person or entity possesses.